Welcome to the Riskwiser Zone, the show where we dive into the world of finance and explore the latest trends, insights, and expert advice to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's topics with you. We're starting off with a fascinating story that caught my attention recently. Imagine a scenario where artificial intelligence assistants are being used to provide investment advice to middle-class Americans. Sounds like science fiction, right? But it's not. In fact, a recent experiment involved asking 5 different AI chatbots, including ChatGPT, Claude, DeepSeek, Gemini, and Grok, for their top investing strategy recommendations for middle-class investors. The results were intriguing, with most of the AI assistants suggesting that investing in low-cost index funds and taking a long-term approach is the way to go. ChatGPT, for example, recommended investing $500 per month for 25 years at an average return of 8%, which could potentially yield over $472,000. Claude emphasized the importance of starting early, saying, "Time in the market beats timing the market." Gemini and Grok also weighed in with similar advice, highlighting the power of compounding and the benefits of dollar-cost averaging. However, one AI assistant stood out from the rest. DeepSeek took a slightly different approach, framing its response around the behavioral aspect of investing and encouraging users to pay themselves first by prioritizing savings and investments over daily expenses. It's interesting to see how these AI assistants are being used to provide investment advice, and it raises important questions about the role of technology in personal finance. Can we rely on AI to make smart investment decisions, or is human judgment still essential? We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of economics and finance now. Today, we're looking at a significant development in the UK, where Chancellor Rachel Reeves has hinted at a potential rise in income tax in the upcoming budget. This announcement has sent ripples through the financial markets, with the pound falling to a 7-month low against the dollar. Now, let's break down what this means. The Chancellor's suggestion of a broad-based tax rise is aimed at tackling Britain's mounting debt pile, which currently stands at $2.6 trillion, equivalent to 94% of GDP. This is a significant burden, and the government is looking for ways to reduce its borrowing costs. By increasing taxes, the government hopes to generate more revenue and allocate it towards priority areas such as public spending. However, this move has also sparked concerns about the potential impact on the economy. Higher taxes could lead to reduced consumer spending, which in turn could affect businesses and, ultimately, economic growth. On the other hand, some argue that a tax rise is necessary to ensure the long-term sustainability of public finances. It's also worth noting that the UK's borrowing costs are already the highest among G7 countries, with 1 in every 10 spent on debt interest payments. This highlights the urgency of addressing the debt issue and finding a balance between reducing borrowing costs and supporting economic growth. As we continue to monitor this situation, it's essential to consider the potential risks and opportunities that arise from such a significant policy decision. We'll be keeping a close eye on how this develops and exploring the implications for investors, businesses, and individuals alike. Welcome back to the Riskwiser Zone. As we wrap up today's episode, let's dive into a thought-provoking discussion about the current state of the market and whether we're heading towards an AI bubble. Some experts are drawing parallels between the current tech frenzy and the infamous market crashes of 1929 and 2000. But is this comparison fair? Or are we witnessing a unique phenomenon that's driven by the transformative power of artificial intelligence? On one hand, it's true that the rapid growth of AI-related stocks and the enthusiasm surrounding this technology bears some resemblance to past bubbles. The fear of missing out, coupled with the promise of revolutionary changes, can create a perfect storm of speculation and inflated valuations. However, As Fed Chairman Jerome Powell has pointed out, AI is different from the internet bubble of the late 1990s. This time around, companies are actually using AI to drive real innovation, improve efficiency, and generate tangible revenue. The recent earnings report from Meta Platforms, which saw its stock plummet due to concerns over excessive AI spending, may be a sign that the market is self-correcting. Perhaps investors are becoming more cautious and selective, separating the genuine AI winners from those that are merely riding the hype. This could be a healthy development, as it would allow the market to consolidate and focus on companies with real substance. On the other hand, it's also possible that we're underestimating the risks associated with this AI-driven rally. If the bubble were to burst, it could have far-reaching consequences for the broader market. As investors, it's essential to remain vigilant and not get caught up in the euphoria. Ultimately, the key takeaway is that history can provide valuable lessons, but it's not a guarantee of future outcomes. By being aware of the potential risks and rewards, we can navigate this complex landscape with caution and make informed decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.